Advanced Financial Accounting Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship, the parent owning a controlling interest of the subsidiary but not 100% of the subsidiary. Therefore, we do have a non-controlling interest we will be dealing with. Major focus will be the fact that S is going to issue more stock to the parent, so the subsidiary issuing more stock to the parent company. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to enter that information into the blue area on the right-hand side. That will include our worksheets over here. Then we'll have our consolidation worksheet. So here is our consolidation worksheet. A little bit different here. We got the parent and the subsidiary. That's not different. However, we also have the information that we're going to be breaking that out. And this is where this parent column is coming from, where we will be putting one journal entry with one adjustment and see that reflected on the parent financial statements as well as the subsidiary financial statements. So we're going to record one journal entry each with relation to the new item that we will be considering, that being the issuance of stocks from S to P. So we'll consider that transaction. Back on over to the data. We got P purchased a percentage of S common stock. So the first original percentage is going to be a 75%, 25%. They purchased at book value. So no, we're not going to be dealing with any differential here. And then on January 1st, 2000X0, we're going to say that they purchased directly from S. P purchased directly from S, or S is issuing more stocks, that being 2,500 stocks at a cost of 150,000. So now P's getting more stocks, but those stocks are being issued directly from S, okay? So that's going to be the transaction here that we're going to be dealing with. So let's consider this in terms of the equity section first. So we're going to go down here and do our typical kind of thing and think about S company's basically equity section. Now to do that, I'm not going to be pulling it from the consolidation, because what we're going to do is we're going to enter this transaction. We're going to look at the financial statements before this issuance has taken place, because it happens on January 1st. And then we're going to do the consolidation directly after that time period and see what the change will be. So therefore, I'm going to look at S's equity section before the beginning balances, which will be reflected all the way over here on S's trial balance. So I'm looking at the beginning numbers on S's trial balance, and then we're going to pull those numbers in, and then we'll make an adjustment related to the issuance of the stock that are taking place. So I'm going to say, all right, let's first take a look at this. We're going to say the beginning balances for S. Beginning balance. And let's take a look at the equity accounts. So I'm going to look at the common stock, the additional paid in capital, and the retained earnings. So I'm going to say negative of, and I'm going to scroll all the way over here. Make sure I'm going all the way over to S's balance. I don't want the second column. The first column is what I want, because I'm going to post something to it. If I pull this from the second column, I will end up with a circle reference or messing up my numbers when we post to the middle column. So notice I'm just picking up this 100,000 from the beginning balance of S in the common stock. I'm going to do the same for the additional paid in capital. So I'm going to do the same for the additional paid in capital all the way over to S's books over here. We're going to be picking up the 32,000. And then I'm going to do the same for the retained earnings. I'm going to do the same for the retained earnings all the way over here on S's books. We're going to pick up the retained earnings. So we've picked up now the three components of the equity section. We're going to sum that up. So I'm going to say equals the sum of those three numbers, that adding up to 322,000. So once again, if I go all the way over here, of course, equity section, adding these up, 322. If we say the assets minus the liabilities, they add up to the 322 as well. Now there's going to be new shares that are going to be issued. So now we're going to say new shares issued. New shares are issued. With regards to S's book, what's going to happen for S's books? Well, they're going to be issued at a cost of the 150,000, and they're on the books. If we scroll all the way to the right, once again, we'll see that they have a par value of, well, we're going to say the par value is $10. I'm going to say $10 par value. So that means we're going to say that we have this equal to the 2,500 times 10 is going to be the 25,000. And then the additional paid in capital, they were issued for 150. So our typical process would be if they were issuing them to anybody, not simply the intercompany. This is typical process. 150,000 minus the common stock. That would be additional paid in capital of the 125. No change to the retained earnings. So then the total then would be $150,000 change, and the ending book value, if we sum these up, we're going to say common stock is now at 125. Additional paid in capital for S is now at equals the sum 157, and then the retained earnings is still at the 190. We can then sum this up vertically, which is the 472,000, or horizontally, also adding up to that 472,000. So what basically happened here, of course, in the equity section, the value went up by that 150,000 because that's how much, from S's perspective, and we're not thinking about the intercompany-ness of this. From S's perspective, if they issued more stock, they would have gotten another 150,000 of cash that's now just simply allocated to the equity section in accordance with the par value, 25,000, and the additional paid in capital, then at the 125,000. Okay, then let's just also consider that with regards to a journal entry. What would that look in terms of a journal entry on S's books? So normal journal entry, if we go all the way over to S's books, what would that look like? This is the balance before that transaction took place, and then we're just going to say normal kind of issuance of stock taking place, and we'll have to deal with it with regards to the consolidation. So we're going to say, all right, well, they would just say that cash went up. They got 150,000. It came from P to S, but we're going to say 150,000 would be recorded on S's books. I'm pulling that from the 150 in the data. Then we're going to say that negative, I'll just pick up the 25,000 that we put in the table. The 25,000 would be here. And then the difference is going to be the negative sum of those, which would be the 125, the 25,000 being the par value amount, common stock, the difference being the additional paid in capital. So if we were to record that out, then we would expect assets to go up by the 150,000, the common stock to go up by 25,000, and the additional paid in capital going up by the 125. Obviously, the assets increasing, other side of the equation being the equity increasing for, in essence, an investment, the issuance of stock, ownership, putting money into the company. Now let's think about what happens with the ownership percentages when this change happens. So let's consider this. If we say, well, the beginning balance, we had how many stocks that were issued? We'd had 10,000, which was, we can calculate this way. It was I'm going to say negative, to flip the sign because it's all the way over here. That was that 100,000, and we said the par value was 10 divided by 10. So that's going to be the 10,000, and P originally had 75% of that. So 10,000 times the 75%, because they had the 75% interest. So you would think they would have the 7,500, the non-controlling interest, people that, other than the parent, would have stocks of, we would think, 2,500 shares. And then we're going to say, all right, then the new shares were issued. Shares issued. So this is going to increase the total number of shares that are out there, which is now 2,500 that were issued. They all went to P. Therefore, 0 went to the non-controlling interest, or you can say, this minus this, nothing went to the non-controlling interest. So now we've got the totals then, if we sum this up, total shares outstanding, 12,500. P now holds on to the 10,000 shares, and the non-controlling interest now has the 2,500 shares. So that means that the ownership percents are going to be, this is going to be, the total, this is going to be the 10 divided by the 12.5, 80%, and the 2.5 divided by the 12.5. So the new percentages, it was 75-25. After this takes place, we're looking 80-20 for controlling, non-controlling, respectively. So now we got to think, okay, well, how are we going to, now that we have an 80-20 breakout, how are we going to be allocating, our percentages? Because we should be reflecting an 80-20 for, in essence, the net income, and the equity section for parents' investment in S. So how are we going to account for that? So one way we can think about this, and notice we don't have any differential, so we can kind of say, all right, well, the beginning book value was the beginning book value. I'm looking on S's books again, so I'm just going to say negative sum beginning book value. I'm going to go all the way over to S's books, and I'm picking the beginning numbers. This is going to be this side of things, 100, the 32, and the 190. We were at the 322,000. Now, if we break that out with our new percentages here, we're going to say, all right, that 322 for this non-controlling interest, I'm going to multiply that by the old percentage up top, which was 7525. This is where we're starting, and that was the 80,500. And the old percentage of that 322 times the 75 up top is what we have up top. Now we want it to be broken out 80-20. So then once we issued the stock, we're going to say, all right, issuance of stock, and that's going to be for the 150,000. So 150. So now we have an ending balance, which is going to be the sum of these two. Now on the ending, now we'd like to see our ending balances. I'd like to see the ending balance broken out between our new percentages, the 80 and the 20. Now notice I kind of flipped here from parent to the non-controlling interest, parent. So just be aware of that. So I'm going to, in essence, we got to say, okay, how are we going to break out that 150 to get to an 80-20 ending balance? So in other words, I'm on the non-controlling interest side. I'm going to say I would like this to be that 472 times the 20% here, because this is the non-controlling interest. And then I would like this to be the 472 times the controlling interest, or the 80%. So then we could subtract it out, or we can kind of back into then this number. We could say, okay, then how are we going to, and I'll make this yellow just to show that we're kind of doing this. This is like the last step of the process. So, right. Last step of table. And we're going to back into this now. So that means that we're going to break out this 150 at the 94.4 minus the 80. And that'll give us the 13.9, and then this will be the 377.6 minus the 241.5. So those two obviously adding up to the 150. So we're breaking them out in that format. Note the percentages aren't what we would expect, right? So if you look at that breakout, you're like, all right, that divided by the 150 is like 9-something%, right? That's not what we're expecting here. We're breaking it out. We basically breaking out to get the ending balance to be in alignment with the 80-20 or 20-80 controlling or non-controlling to controlling or non-controlling interest. So now let's go back up top and see if we can recalculate this number, breaking this out between the non-controlling and the controlling interest. So we're going to start with the beginning balance. I'm going to take the same equity numbers for S, which is going to be, I'm going to say negative sum. And we'll be picking up the equity numbers all the way over here for S. That's going to be the 100 through the 190 on S's beginning trial balance. You can also pull that number. It's the same number, obviously, here as well. And then we have the new shares. Let's make this beginning balance. And then new shares were the 150. The 150 here, and then now we're going to be pulling this information in. So let's break this out. The beginning balance here is going to be broken out at where we started. So we're going to say this is going to be that 322 times the 75. This is going to be that 322 times the 25, and that's going to be our beginning balance. Now we're going to be picking up the new shares, and this is where we're going to take this new share information from our table down below that we calculated. So instead of breaking it out between 75-25 or 80-20, we're going to be breaking it out in accordance with the non-controlling interest, the 13.9, and the controlling interest, the 136.1. So if we were to add those up, we get the 150, and then we're going to say the ending book value, if we sum these up, is going to be equal to the sum of adding these up. I'm just going to add them up individually so you can see the process equals the sum of these. And of course, if we sum them up this way as well, we get that 472 as well. So same 472 here, 472 here. Now, everything here makes sense until this point is the funniest part of this process, right? So we went over here and we said, okay, that means that S recorded on their books what makes sense, right? Over here, that makes sense. But then over here on P's books, we got to put something on the books so that the equity method reflects the proper balance on P's books. So what would P do with this transaction? You would think, I'm going to put cash first just because that's the first thing, the easiest thing to think about. You would think that cash here would be credited, of course, and it is, by the 150,000. And then you'd say, well, then there's an investment in S. So we've got the investment in S that would be the debit. And you'd think the debit would just be for that 150,000. But we're actually going to take the debit here in order to get our equity methods lined up. We're going to be picking up the debit of the 136.1, the 136.1. And then the question is, well, where are we going to put the difference then? Going to line up. And that's going to go into the additional paid in capital. So that's negative sum of these. All right, so there's our adjustment. So then we're going to say, all right, then that means that S cash goes down. That makes sense. And then we have the investment, but it's only for the 136.1. So we can line up to our percentage interest and then the additional paid in capital. Additional paid in capital, 13.9. So now if we take our ending balances here, if we were to do our consolidation after this transaction, P's ending balances, S's ending balances now being pulled into our consolidation worksheet for P and S, and we can do kind of our normal elimination entry process at this point. So now we're going to say, all right, let's just pull these in. Then we can sum them up. And so I'm going to say copy and paste that on down. And then we'll do our normal kind of consolidation process at this time. We've got the investment account, and then I'm going to do the common stock. So common stock, it's got a credit in it. So we're going to do the opposite thing to it, which of course is a debit. Additional paid in capital. S account has a credit in it, so we'll do the opposite thing to it, which will be a debit. And then we have the retained earnings. Retained earnings has a credit in it, so we'll do the opposite thing to it, a debit. We don't have anything on the income statement yet, so we're just going to say then the other account we got to deal with is the non-controlling interest in A. And so now, of course, these accounts represent assets minus liabilities. That's the 472,000, which is assets minus liabilities. 472,000 equals equity 472,000. We can just simply break them out now with regards to our new, percentages that we have. The new percentages being the 80-20. So then I could say, okay, this would typically be the negative sum then of assets minus liabilities times our new percentages, this being 20% for the non-controlling interest, and then for the controlling interest going into the investment account, I'm going to say negative sum assets minus liabilities times, closing up, times the controlling interest, or 80%, times the 80%. Then this should be in balance now. Asset, or the debits equal the credits. That looks good. Let's post it out. Here's the investment in S. Up top in the investment in S, we're going to record that. That should bring it on down to 0. Brings it on down to 0. Then we're going to go to the equity section. We're in the common stock. Within common stock, we're going to be picking up the 125, bringing it back down to the parent portion. The additional paid in capital, bringing it back on down to the parent portion. Then the retained earnings, bringing it back on down to the parent portion. Now we're on the non-controlling interest in the net assets, and we're going to be picking that up at the 94.4. End of the day, it nicely works out here. So we have the investment account going down to 0 as we would expect, and we see that the equity section is basically reflective of P's equity section here, and then the non-controlling interest component of it.